Hello friends, this is the part 2 of our video on gold investments. In the last video, we discussed about the 5 methods of investing in gold up till gold mutual funds, their advantages and disadvantages. In today's video, we will see in detail about sovereign gold bonds, their advantages, disadvantages. We will compare and contrast all the 6 methodologies, and towards the end of the video, we will make a simple illustrative comparison of all the 6 methods by showing a investment of 1 lakh in each of the methodologies and what are the effective returns that we are going to get. Before we start the video, a brief disclaimer: we are not financial experts or investment experts. So while you see this video, we request you to make your do your own research or consult your financial advisor before making any such investment decisions on gold. Now let's get into the video. A quick recap. So this is a price trend of 24 karat 10-gram gold over the last 50 years. In 1971, it was 193 rupees, and by 2020, it multiplied by 250 times to reach around 50,000 rupees. So gold is a very good investment. If you look at the last 20 years, the average annual returns have been around 13.6%. And if you look at the last 10 years, the average annual returns have been 11.5%. If you compare this with bank FD rates, in the last 20 years, it was between around 6 to 6 to 10%. And currently, it is much lesser, it is around 5%. So definitely gold is a very good investment instrument. Hey, but hold on, all types of gold investments will not yield such a returns. You'll have to invest very carefully. You'll have to look at the additional charges. Let's continue with our previous video. Let's look at sovereign gold bonds. What are sovereign gold bonds? Sovereign gold bonds are issued by the RBI on behalf of Government of India. The value of sovereign gold bond is pegged at 99.9% pure gold. It has a maturity period of 8 years and you can redeem in 5 years. You can buy from a starting value of 1 gram worth of 24 karat gold. More importantly, unlike other modalities of investment, sovereign gold bonds provide you an additional annual return of 2.5% simple interest on your initial investment. Now, where can you buy sovereign gold bonds? You can buy in any of the nationalized banks or scheduled private banks or foreign banks. You can buy in designated post offices in Stockholding Corporation of India. If you hold a demat account, you can buy through your broker. So usually these sovereign gold bonds are issued in multiple series, around 5 series a year. You can look at the RBI website to see how many series have been issued and the date of issues. Now let's look at the advantages. Number one, sovereign gold bonds do not have making charges or wastages unlike gold jewelry or coins. It's a government backed security, so it's very safe. In addition, if you're applying sovereign gold bonds online, you will get a 50 rupees discount per gram, which is around 1%. As I had discussed earlier, there is a simple interest of 2.5% every year in sovereign gold bonds. It's very easy to buy from your banks, stockbrokers, or post offices. Most importantly, it does not have GST, very similar to ETF and mutual funds. It does not have GST. It doesn't have any storage cost. Digital gold, while it has a spread cost, or sovereign gold bonds, there is no storage cost or there is no risk of theft. So if you want to store in a bank locker, which usually happens with your gold coins or bullions or the jewelry, sovereign gold bonds do not incur such costs. Unlike ETFs or mutual funds, if you are redeeming sovereign gold bonds after 5 years, there is no LTCG, which is long-term capital gains tax, or short-term capital gains tax. I'll discuss about the two types of tax in a later video. Let's say if you want to redeem it much before 5 years, you can trade this in stock market and you can redeem it. But if you're trading it before 5 years, these a long-term capital gains tax and short-term capital gains tax may be applicable depending on the time window. And the last benefit is most of the people do not know you can still keep this as a collateral in financial institutions and banks, and you can take loans from there. If you look at disadvantages, there are not a lot of disadvantages. One disadvantage is if you want to convert it into gold, that's not possible with sovereign gold bond. It's not a highly liquid asset like a ETF or a mutual fund. The volume traded is very less. and it has a maturity period of 5 years, which is slightly long. So people who want money immediately, who are in urgent need of money, it's not a great instrument. Just in case if you're trading ahead, if you're trading before 5 years, LTCG and STCG is applicable. Now, let's compare all the six modalities of buying gold. First, purity. Gold jewelry, the maximum purity you can get is 91.6%, whereas all the methods you get 24 karat gold, either 99.9% or 99.5%. Making charges is a very big burden in gold jewelry. Sometimes it reaches around 30%, both making charges and wastages. And that if you're going for stone studded jewelries, it's going to be significantly high. So I'll post a new video on how to buy gold jewelry and the things that you need to note down in gold jewelry. But time being, so it's a very heavy burden if you buy gold jewelry. While gold coins and bullions also have making charges, they are not very high. They are in the tune of around 2 to 10%. On an average, it would be 4% depending on where you buy. In case of digital gold, while it is not there, in case if you want to convert it to a coin, at that point in time, you may have to pay making charges and wastages. ETFs, mutual funds, and gold bonds, they do not have any such charges. Similarly, GST is applicable in jewelry, coins, and digital gold, while the remaining three methods do not have GST. Expense ratio or commission. So this is usually levied in ETFs and mutual funds, and mind you, these are year on year. In ETFs, on an average, it is around 5.5%, and mutual funds, it's a little more than 1%, and it is levied every year. In case of mutual fund, if you are redeeming it before the lock-in period, you may have to pay a penalty, which is called the exit load, which is around 1.52% depending on the fund house. Brokerage and transaction taxes are negligible given we have brokers such as Upstox, Zerodha, so I am ignoring it. In case of digital gold, there is an additional cost of spread cost, which is to cover the storage, insurance, and transaction, which is not there in rest of the modalities. If you consider these set of parameters, sovereign gold bond seems to be a better option. Now let's look at the other parameters. Considering the storage risk, the risk of theft, safety, gold jewelry and gold coins are risky. Either you have to store them in the bank locker incurring cost, or you have to take risk on your own, while the rest of the modalities do not have such risks. Uh, if you want to convert any of these modalities into actual gold, first four methods you can convert it into gold, whereas mutual funds and sovereign gold bonds you cannot convert into gold. Gold ETFs have a minimum limitation, as I had indicated earlier in my last video, it is around 1 kg. And digital gold, if you want to convert, there is a minimum deliverable quantity that you need to note down. But these can be converted to gold metal. If you look at the minimum investment, digital gold is a winner here. You can start investing very, very small. Sometimes you can start your investments from rupee 1. In case of gold mutual funds, if you're going for an SIP, you can start as low as 1000 rupees. Whereas in the rest of the modalities, you'll have to buy at least 1 gram. In case of gold jewelry, that also varies depending on where you're buying and what you're buying. You look at a lock-in period. Gold mutual funds usually have a lock-in period, and if you want to withdraw before that, there is an exit load applicable. While sovereign gold bond has a maturity period of 8 years, you can redeem it in 5 years, but you can trade before that in stock market as well. If you look at digital gold, while there is no lock-in period, there is a cap on the maximum number of years which you can hold digital gold, after which some charges will be applicable. So it's better to redeem before that limitation. If you look at additional returns, only sovereign gold bonds provide you an additional return of 2.5%, while the rest do not provide any additional returns. Applicability of capital gains tax. Most of them it is applicable. Only sovereign gold bonds, if you are redeeming after 5 years, it is not applicable. From a regulator standpoint, sovereign gold bonds is backed by Government of India, RBI. Gold ETF and gold mutual funds, since they are traded in stock market, SEBI is a regulator, while you do not have regulator in these three modalities. How liquid are these or all these six assets? Sovereign gold bonds are the least liquid because they are traded in very low volumes. Gold mutual funds are slightly more liquid than ETFs. Jewelry and coins, you can keep them as a collateral in banks and you can convert that into money. As I said, Your gold jewelry definitely can be kept as a collateral for loans. Gold coins, there is a limitation of 50 gram and bullions are not accepted. You can keep your sovereign gold bonds and ETFs as collateral in banks. Digital gold, if you convert it into gold, you can still keep it. While in digital format, I'm not very sure. The rules are not very clear at the moment. Okay, we have compared all the six modalities in different parameters. Now let's do a simple illustration of, say, if we invest 1 lakh in the year 2021, how much of returns I'll get in each of these modalities after 5 years, that is in 2025. First step, if we are investing 1 lakh in each of the modalities, we need to understand how much is the effective investment after all these charges. If you look at gold jewelry, because of this GST and making charges, the actual investment would be much lower than 1 lakh. And since gold coins also have a bit of making charges GST, it would also be less than 1 lakh but slightly more than jewelry. Digital gold also, you can invest only after deducting GST. While ETFs and mutual funds have expense ratio, so the investment happens after the deduction. So I've taken an average of 15% here. So if you look at 1 lakh investment, the actual effective investment in gold is around 82,000 here. And in gold coins, I've taken around 5%, it is around 92,000. In all these modalities, it is less than 1 lakh, while in sovereign gold bonds, it is 1 lakh is invested as is. Now, let's assume that every year the gold prices increase by 10%. Okay, so if you apply 10% compounded over 5 years, this will be the actual increase in the value. So the 82,000 odd money increases to 1,32,000, and the 92,000 becomes 1,48,000, and similarly. And sovereign gold bonds reach up to 1,61,000. You may ask, the investment amount here was higher than digital gold, but it is giving a lower returns. It's because for each of the 5 years, there is an expense ratio of around 1.5% levied here that reduces the net value. Now, if you are redeeming a gold jewelry, even in a jeweler, they would apply a loss percentage and then only they will provide a redemption. If you are redeeming digital gold, there is a spread cost of 3%. Whereas when you redeem sovereign gold bonds, every year it would have provided an additional 2.5% of returns. So in case of 1 lakh, every year 2500, which amounts to 12,500 over a period of 5 years. So if you look at effective returns, sovereign gold bonds have fetched around 1 lakh 73,000, whereas gold jewelry has fetched around 1 lakh 29,000. The total percentage return, yeah, sovereign gold bond is a winner, while the loser is a gold jewelry. The average annual returns, sovereign gold bond, assuming the 10% is the gold price increase every year, sovereign gold bond has given a significantly higher return, while the rest of the modalities are around 8 to 9%. Okay, now I've seen this example. So, what are our key takeaways? So, the modality of investment depends on your need. So, if you look at it, you need to understand what is your objective. If your objective is investment in gold, do not go for jewelry. In the long term, sovereign gold bond has the highest returns. So if there is no need on any urgent conversion or redemption, sovereign gold bond is the best methodology. If you are starting very small, say around 500 rupees, you can go for digital gold that provides the option of investing in very small. If you want to start a SIP, mutual funds are the best way, while ETFs are cheaper than mutual funds, but you cannot go for SIP. Okay, friends, now I think you would have gotten a clear picture of different types of investment, different modalities of investment and gold, their comparisons. What do you think? How have you invested? Please comment in the comment box. If you had liked this video, please give us a thumbs up. Please subscribe to our channel. If you find this video useful, please share it with your friends and relatives. Thanks for watching.